Hello, and welcome to the CalCPA's Tax Bill Series. I'm Troy Lewis from BYU, and today I'll be covering updates and insights on select itemized deductions. Thank you so much for joining me. The OBA, the One Big Beautiful Bill Act, had several provisions that were effective in 2026, but they also had several provisions that were effective in 2025. And many of those provisions impact individual taxation requirements. So what we wanted to do today was go through some of those requirements and some of those itemized deductions. In other series, you'll have dealt with the state and local tax, but these ones that we're dealing with today are any less important. First, we want to talk about the home mortgage interest deduction. One of the biggest assets that taxpayers have usually in their portfolio is their home residence. So this is a big item for most taxpayers. The TCJA modified back in 2018 how much interest a taxpayer could deduct on their mortgage. They can deduct the interest up to $750,000 of principal if they're married filing joint, or $375,000 worth of borrowings if they're married filing separately. Now, this has been on a federal basis. As many of you are probably aware, California never adjusted or never accepted those limits, and the California principal amount is $1 million. Also, back in 2018, the home equity lines of credits that existed, back in 2017, taxpayers were allowed to deduct the interest they paid up to $100,000 of home equity line credit, but that was taken away for federal, not for California. Well, in the One Big Beautiful Bill Act, or I'll just acronym OBA, the federal changes in 2018 were now made permanent. So permanently on a federal basis, if you have a mortgage that exceeds $750,000, some part of your interest that you pay will be limited. One thing that's really important to note here, though, is that the interest that you may be paying on a debt tied to your home, even though it might be a home equity line, meaning it's like a second mortgage, it doesn't mean that the interest that you pay, the taxpayers pay, may not be deductible. And in fact, if you look at the tracing rules and we look at how you actually spent or what you did with the money that you borrowed, that's very possible that interest could be deductible as investment interest expense, or perhaps business interest if you use the money in a business. Likewise, one other change that will be effective in 2026, again, we've had this in the past, is if you have a taxpayer that's paying mortgage insurance premiums, or what we acronym PMI, the amount that they pay for PMI will be treated as interest for a mortgage or acquisition debt interest starting in 2026. Charitable contribution deductions also saw a change effective in 2026. So not for 2025 tax years, but for the 2026 tax year. Just like our medical expenses, there's now going to be a new AGI floor, meaning that 0.5% of the AGI of a taxpayer is going to be used as a floor, and any deductions that your client or your taxpayers may be giving for charitable purposes, the first 0.5% of AGI will simply be lost, just like we have on the medical. Cash gifts is applied first to this limit. Those amounts of contributions that cannot be used will also, just like in the past, be carried forward on a FIFO, first in, first out basis, where the cap is exceeded. So if I give a lot of money this year to a charity, I can't use it all, I will see the excess carried forward for 5 years. Understand that in California, the changes that were made back in TCJA were not adopted. There is no floor, so there will be another California federal adjustment. And 50% of your AGI is the limit for California, whereas it can be as high as 60% for federal, and that change was made permanent. So, for example, if you have a taxpayer that donates $100,000 or has $100,000 of income, and they donate charitable contributions of $1,200, so $1,200 of contributions, for federal purposes starting in 2026, your taxpayer will only be able to deduct $700 rather than the $1,200, like you will still be able to do in 25, and you also will for California. And this brings me to a good point to remind everyone that just because this exists now, we still need to make sure contributions are not allowed to be deductible as charitable unless you meet the proof of contribution rules, which means you can prove that you've actually made a contribution. And perhaps even more importantly, you meet what's called the contemporaneous written acknowledgement rules, which is that piece of paper that you get from a charity that says, and it's very prescriptive, it's very clear, that you've given money and you didn't get anything in exchange, or if you did, here was the value of it, and you have some reportable information. That document must be in your taxpayers' hands before they file. Even if you obtain that document after they file, that's a problem. So this is just a good reminder that as we're working with our clients, we need to make sure that they have the documents in place before we file their return. In 2026, we will see another charitable provision come back, and that is the cash gifts to public charities, so not to private foundations and not to donor advised funds, or what we call DAFs, but up to $1,000 or $2,000 married filing joint will be deductible as a from AGI, but not as an itemized deduction for federal purposes. So that means even if I'm not going to itemize deductions, I have the ability to take a deduction potentially of $1,000 or $2,000 if I'm married filing joint as a charitable contribution, and noting California doesn't comply with that. Personal casualty and theft loss, as many of you probably are aware, California never adjusted or never adopted the suspension of that provision. But for federal purposes, you can only deduct a casualty loss if that loss is in a federally declared disaster area. 2026, that will only be the case if it's federal or state declared. So now we'll have state declared with it as well. If you have clients that gamble, there was a provision that was put in that's very controversial, but still it's the law today. California does not adopt this, but basically 90% of your losses are all you can take. And that's assuming that you can itemize. So first of all, in order to deduct gambling losses, you've been historically limited to your gambling winnings in the past, but it was an itemized deduction. Well, starting in 2026, you have another haircut. You have to take 10% off of those gambling losses to find out what you can deduct. So here's just a simple example. You have 50,000 of gambling winnings. You lost $40,000, so you netted 10. Well, the taxable income for federal purposes is now going to be $14,000 starting in 2026. And the reason why is you're limited to only taking 90% of your losses, even if those don't exceed your winnings. This is going to be a very controversial provision we'll need to watch, but in 2026, this is what we're scheduled to do. Our educator expenses, California doesn't have this, but starting in 2026, if an individual K-12 educator has expenses in addition to the $300 that they can take now, they'll be able to take the excess as a from AGI deduction, as an itemized deduction if they qualify. All of the other miscellaneous itemized deductions that were suspended in 2018 have now permanently been suspended. And here's a list of those items for you that you can think about. But if the law had been changed with OBA, we would have seen in 2026 all these items come back with a 2% of AGI limit. Now they're all permanently gone from federal purposes. Overall, one of the other provisions that we'll see come in 2026 is if you have high wealth individual taxpayers, a percentage of their itemized deductions will be lost and will be phased out like we used to have back in 2017. It's a little different mechanism now, but you'll see that high wealth individuals will lose their individual tax deductions as a result of being phased out. And here's some basic brackets to give you an idea. It starts at the 37% bracket for federal. So if your client's below that, they won't have their deductions phased. And finally, just as a general reminder, while we're talking about itemized deductions, and they are really important, so many Americans don't itemize because of the limitations. But I think that's going to change now that we have the SALT deduction. So beware, and hopefully this will give you a good head start on the upcoming filing season. I wish you the best of luck. Thanks so much, and thanks for joining us at CalCPA. Please stay tuned for more episodes in this series.